Much that's aluminum and commodities in focus. Now, Mangalam is standing by with the latest on Trent. Mangalam.
Well, Trent is doing extremely well in today's trading session, marginally off highs, but the results were mixed, so to say. The revenue for the company grew at around 54%. It was the highest ever quarterly revenue, led by Westside, which did about 17% same-store sales growth. However, we saw contraction in their gross margins as well as their EBITDA margins. Remember, same time last year, we did see a fair amount of rent waivers, etc. So operational expenses have been higher over and above the raw material pressure that the company is facing, as a result of which the consolidated margins of the company have been 14%. The net profit growth has been led by higher other income. So the street perhaps has chosen to side with the revenue growth as against the operational weakness, because now that raw material prices are off highs, maybe street believes that going forward margins will improve as well. The only thing that keeps a lid on the gains are the valuations. While the stock is off its 52-week high, remember it's still trading at around 76 times one-year forward earnings, as a result of which Jefferies has a hold rating on the counter.
Okay, all right. Mangalam, thanks a lot for that. Well, Ekta joins us as well to tell us about Piramal Pharma. Well, Ekta, there was a debate whether or not there is value or it's a trap. For the time being, the management has really missed their estimates. I mean, what they guided for the second half of the year. Disappointing numbers, right?
Absolutely. It is a disappointing set of numbers, and management had indicated that generally second half is when they would probably see better numbers, better recovery. That hasn't come through. The piece of news additionally, besides the numbers, is that they've approved a rights issue of around 1,050 odd crores. Now, coming to the numbers, revenue is up 11.5%. The key disappointment unequivocally is definitely the margins this time. They've come in at 5.1% versus 14.7%. The loss has widened to 90 crores versus around 37 crores on a Q-on-Q basis, but versus a profit of over 160 odd crores same time last year. Q-on-Q as well, margins at 5.1% versus 10%. Now, 9 months as well, as a whole, the margins have come in at 6% versus 12%, and the loss is at over 230 odd crores. Now, in terms of the revenue, it's really not a revenue problem. The street would have forgiven the company if it was a revenue issue. CDMO Q3 revenue is up around 14% year-on-year. Complex hospital generics, which is basically anesthesia, drugs, etc., is up 6% year-on-year. India consumer health, which is basically a whole host of brands which they sell, many of them over the counter, is up around 37% year-on-year. So that's done very well. They also have a strong track record when it comes to the US FDA. 12 years, no OAIs or official action indicated status, but the street doesn't really want to look at that at this point in time. Stock is down over 50% from the listing price of around 201 rupees. And remember, until now, post the listing, there have been a couple of brokerages which have been quite positive on it. For example, Axis Cap initiated a coverage with a buy at a target price of 160, and Jefferies initiated with a buy and a target price of 150. Stock is way below those target prices. Call at 5 p.m. today. So the street will watch out for what the management has to say.
All right, Ekta, thanks a lot for that. So lots to watch out for in terms of individual stocks, but don't go anywhere.